Hello, Jim here. I've been selling covered calls for many, many years, probably going back to around 2010, and I've been able to make some good money year in and year out. Today, I want to talk about the guidelines I like to use, how my strategy has changed over the years, and the things that are really making a big difference now. I'm going to share with you a few different trades that I've done and then a little bit more in depth about my guidelines. So stay tuned. I think you're going to enjoy what I have for you. Let's go ahead and jump right in. Now, I just put together a short list of items that I want to talk about. The first being, again, the selection of the underlying assets. Now, typically, for me at least, I had already purchased Coca-Cola, and I had quite a bit of shares. Actually, a lot of the shares were given to me from my grandfather many, many years ago. I think I was a teenager, probably 45 years ago or something along those lines. So that was less of an issue having selected the right stock or ETF. But it does make a difference. So just like I talk about in my previous videos, taking the time to pick the right companies, again, picking companies low in debt, high in profitability, fairly good growth or some growth, and just well-managed companies. To me, if you pick the right companies, you've won half the battle. And I've talked about that in many videos in the past. So, and then one thing to keep in mind for covered calls, at least the way I look at it, if you're starting new with selling options, covered calls is a great way to begin. And what I typically recommend people to do is once you've set up your account, you'll typically find out that, well, I've got 40 shares here, 52 shares there of different stocks. And you might need to kind of reconsolidate. You might need to get rid of some stocks with the emphasis of you need rounds of 100. So, instead of having 52 shares here, 22 shares here, you're going to need to have like 100 shares of this stock, 100 shares of this ETF, 200 shares of that stock, and so on and so on. So one of the things I do with a lot of my members is talk about how to do that, how to identify, the companies that potentially you might want to get rid of. Or, maybe you have 114 of one stock that you can get rid of 14 shares and put it towards another stock that gets it to 100. So just something to keep in mind, because again, when you sell options, it's always in increments of 100. So to be covered in the way a covered call works, you need at least 100 shares. So that's just a good rule to keep in mind going forward. And I do think covered calls are a great way to begin when you're first starting. Some people, may choose that's all they want to do. They don't want to do anything else but covered calls, mainly because it's easy to understand, the fact that someone will pay you for the opportunity to buy your shares. And a lot of times they'll pay really, really nicely. And you can pick up more premium the farther you go out. So you can kind of identify some guidelines and strategies to use, which I'm going to share with you my strategies. But the premium income can be fairly substantial. Like I said, going all the way back 14 years, I would bring in $2,000-3,000 a year just doing a little bit of trading, and then I up that. And I continue to up it. Now that I'm selling puts and using other strategies, the amount of premium I have coming in is pretty substantial. You do need to manage risk. Usually the biggest risk is, you might sell a covered call too low. Maybe the stock shoots up and just blows right past that covered call strike price, which kind of puts you in a weird situation, because you could find yourself deep in the money, and sometimes you can't get out of it. Again, though, just like with other types of options, go back to why you decided to sell that covered call and that you were okay with selling the stock at that price. That's kind of for many, many years, I didn't really have any guidelines. I just knew, and I only worked with Coca-Cola, so I knew, well, Coke is $50. I'm willing to part with it at $55, so I would sell a covered call at $55. And that worked really well. It was many, many years before I had my first shares ever called away. I think just by the nature of it, I kept it relatively safe. Now, as you get more sophisticated and you want to put a little bit more logic into it, you can do or you can use what's called the Greeks, and I like to use delta. And to me, delta is a probability of how likely you are to be assigned, or those shares be assigned away from you. And I use what's typically called a 20 delta. So it's like a 20% chance that someone's going to take those shares from me. But again, we're going to go into a little bit more detail with that. And then, managing risk, the biggest risk again is that early assignment, someone taking those shares away from you because, the price of the stock shot up too quickly. A lot of times what happens is people will start selling covered calls on a stock, and then the stock will die. Maybe it drops 10, 20, 30%. And then, they start selling covered calls really quickly, and they start selling those calls in the money, or not really in the money, but below your cost basis. So say you purchase those shares for $50 and you start selling covered calls at 40, and suddenly the stock becomes healthy again and it shoots back up. Well, you run the risk of having those called away for a lot less than what you paid for them. So to me, that's probably the biggest risk. And I found that it works similar to puts, that if it's less than 10% in the money, so if it's a $50 stock and it hasn't, it is in the money, but it's not more than, say, $5 in the money. So in the sense, if you sell a $50 call and the stock goes up to 55, any higher than that 55, the chance of early assignment goes up, in my mind, drastically. What I did is kind of looked at a lot of my trades, and the ones that were early assigned, that's what I identified. More so with puts, but it looks like it also works that way with calls. But I've also had other companies that have been in the money for years, and I just keep rolling them. Con Edison is one example. I think right now it's probably $10 in the money, so it kind of breaks that rule, and I'm able to continue to roll it. I do think it's going to get assigned away from me at some point. So let me talk about my guidelines. Now, this is my planning worksheet, and I provide this to my memberships. I sent this out earlier today. If you want to learn more about my memberships, take a look below. I have what I call the Investor Club, which gives you access to all my trades, gives you access to all my workbooks and spreadsheets. What it doesn't give you access to is Discord. I have a lot of members who are sharing their trades and discussing tools. And that's mostly occurring in the Discord. So I have a higher membership that's called the Traders Club that includes Discord. And then I have a little bit more expensive membership that's called my coaching membership, where I provide coaching on a weekly basis. So if you want to learn more, take a look below. I think it's well worth it. I kind of wish something like that existed when I started. And I've tried to make it fairly inexpensive so it's not going to break your budget and you can get in and out. I actually have people leave and then come back, or switch from one level of membership to another. My coaching fills up pretty quickly, so a lot of people will be waiting to get into my coaching, and they may upgrade their plan at that time. So again, if you're interested, take a look. And as always, hit that like button, subscribe. I really want this to get out. So I provide this planning worksheet. And what I do with this, and this is actually going to change, I'm going to probably put in this all my trades. Right now, I probably have 80, 90 positions at any one time. But I identify in this planning worksheet over the next 3 weeks who's going to be expiring. So what you're seeing on this first page is all my positions expiring on June 21st. And I do that primarily because I focus on them. I focus on managing them. Do I need to roll them? Do I need to close them? And then, I have other aspects in this. So I kind of use this as a tool, and I keep adding more and more to it. Now, I have several different sections. I have favorites, certain companies that I prefer. I have another piece I'm working on is what I'm calling trade rankings. I'm trying to find a way to rank the trades. I'm still working on that. Checklists to identify what companies to own, and then guidelines. And this is where I wanted to go. We're going to talk about calls. So, and I update this fairly often. And then, just by the nature of getting this planning worksheet each week, this kind of information is updated. So For calls, again, I like to do what's called a 20 delta. So I like to take about an 80% chance that it's not going to get assigned away, or a 20% chance that it will get assigned away. And I can typically find pretty good premium at that level. Of course, the more risk you take, the higher the premium that you can earn. Now, if you're doing what's called the wheel or the shielded wheel, like in my last video, you can take a little bit more risk. And in a lot of cases, maybe go up to 30 delta, especially if you're one of those that don't want to own the stocks. You just want to kind of churn the account and bring in a lot of income. And then I typically will go farther out with covered calls. So I'll go anywhere from a week to 120 days out, and sometimes I'll do leaps. So if a stock gets in the money, meaning it shoots through the roof, like that happened with Square earlier in the month, and it's happened with a few other companies recently that have gone up really, really high. Williams-Sonoma is another example. In those cases, if it becomes in the money, then a lot of times we'll roll it out, and I'll just try different dates. And I typically like to earn still, just like with puts, about 100 per contract. So if it's 2 contracts, I want to earn pretty close to 200, 250. I've been getting closer to 300 per trade. And that's primarily so I don't have to be trading all day. I like to make a trade or two and then go on and do something else. And I also talk about doubling dividends. So if you have a lot of assets and a lot of stocks that are paying pretty good dividends, and say your portfolio is paying 3 to 4%, then trying to double that. And I've been able to do that in most cases. So instead of earning 3 to 4% on your portfolio, you can earn 6 to 8%, which some people, that's all they really need to retire, and you know, your assets will grow indefinitely, and you can leave more to your ancestors, or to your children and grandchildren. Not really your ancestors. I don't know why I said that. But primarily your children and grandchildren. And then you can, one thing I do like to do now, and I've learned this the hard way, is avoid making a trade right around earnings, especially the day of or the day after earnings. I prefer to wait and stay away from earnings, both making the trade at that particular time or right near earnings, and also picking a strike price that's also really near earnings. It can end up biting you, and that's what's happened with me in some cases, probably recently more so with puts. Now, next, what I wanted to share with you, and I'm not going to go into ranking trades or puts since this is primarily about covered calls. I just wanted to show you what my account looked like. So you'll see 4,400, and I wanted to share this. This is one thing I do. If you own a lot of shares in a particular stock, you can do what I call chaining. So, and it's just literally picking different expirations, picking different strike prices. Coke doesn't move that much. It typically moves between about 56 and 66. And you'll see right now it's pretty close to 53. And you can see a lot of these are negative, some are positive. And a lot of that relates to the fact that it's closer to the strike price. So some of these are negative because it's closer to the strike price. Now, if Coke dropped $2 or $3 and was 59, almost all of these would be profitable. It actually did that early last week. And if it went the other way and hit above 65, then a lot more of these will be negative. But this gives you a bird's eye view, so I can see, well, here I've got 2 contracts that are expiring on 8/16/2024, 42% profitable. And I could say, well, maybe I want to roll these, so I can look out here at another 65. So here's a 65, 6/20, 25. Now that is a leap. That's pretty far out, but you can see I can bring in $3.14. It makes it really easy to see what my opportunities are for rolling when you have a chain like this. And then what I typically do is I try to not have too many expiring. Like typically I try to stay below 4 expiring on any particular date at the same strike price. Like at different strike prices, I'm okay with that, having 4 maybe, but I don't want to go too much higher than, maybe 8 on a specific expiration, because you never know, the market could do a dive, like, of course, we're talking covered calls here. So if it dives and there's major downward trend in the market, all these covered calls would become very, very profitable and I could close them. And that's happened before when we had the big drop in 22. I think I was able to close a good portion of my covered calls, but you can see it makes it easy. So I could see, well, here I've got a 67.50, 11.19.24, sort of about 6 months. And I could say, well, I want to roll that out to 117.25. And again, I can see the difference. I can make $50. So I will do that kind of rolling. If the market adjusts and Coke drops $3, then I can again roll a lot of these, keeping it at the same expiration and go a little bit lower. But you can see, all of these are in the hundreds, and any of the ones I own, like 200, it all becomes rounded numbers, hundreds, 200. And that's kind of what happens. And I encourage people again to buy lots of 100 whenever you're buying stock. Now let's jump into a little bit of detail about what it looks like when you make a trade. So here's what the trading page looks like. I'm using Procter and Gamble. It's another stock I own in many different accounts. I think I have 4 or 5 contracts or 400 or 500 shares in all. And here, you set it up, Procter and Gamble. This is in Schwab, so I'm doing a call. It's currently 164.54. I believe I think I paid like $70 or $80 for Procter and Gamble, so it's been very profitable for me. And then, here I can see, well, I could do a sell to open. I'm going to do one contract in Procter and Gamble at 170, so about $6 higher. And I could pick up anywhere from 218 to 212. Now, if I wanted to see, well, that's too risky, I could go up to 175. You could see I can pick up a little bit less, and maybe this allows me to double the dividend, where this actually produces quite, maybe double, triple of the dividend. But you can play around, you can change the expiration. I could say, well, I'll go out to 1018 and I'll try 175 and, see how that works out. Let me move this up here. So we saw in, 816, 175 is only $85. I go out 2 more months, I can bring in 201. And that's a lot of times what I do. I try to get more per contract and not do too many trades any particular day. I typically do 1 to 2 trades a day. Some days I'll do 3, other days I'll do none. But this is pretty much how the trade looks. Next, you would click review order, and then you'd have one more chance to be sure that you're doing a sell to open and that you're bringing in cash. But once this is fired off, it hits your account right away. And if you own multiple contracts, say you had 4, you can see it's quite a bit of cash. And that's what I've done with Coca-Cola. I've had instances, typically we'll do 2 contracts, but I've had a couple instances where I've done up to 4 and brought in substantial amounts of money. Now, one thing I did want to talk about is, let's do a little bit of research. Now, when I talk about doubling in dividends, one of the things I really like to look at is, by owning the stock, I not only get the dividend, but I also get the appreciation. So here you can see I bought them I think way before 5 years ago. But I believe I bought them at around $85. So I got significant appreciation. But then at the same time, they pay a nice dividend. And then I've been also able to get the dividend. So here you can actually see, this is what I like to see. I like to see that they're growing dividends. And actually, it looks like they're growing the dividends even more recently. I also like to look, well, what's the coverage ratio? That means they've got plenty of cash to cover the dividends. They're paying out maybe 60%, which is an okay amount for a big company like Procter and Gamble. But the beauty of dividends is, if you go back and you had invested in them, let's just say at $85, so I had bought 100 shares at 80 in 2014 at $85, and I was bringing in $2.53. I still own those shares, and now those same shares are bringing in almost $4. Like here, they're bringing in almost 94. You can see they increased them pretty nicely here. So you're talking almost $4 in dividends now compared to 253. And that's why I really like to own these kind of companies. And you can see Coca-Cola is the same way. If I bring up Coca-Cola, it's also, you can see, steady, and they've actually started increasing more recently. They've been doing better. Their coverage ratio, it used to be lower than this. It's higher, or it's lower than Procter and Gamble, but it used to be like this used to be closer to 92%, and this was like 104. So they do have more cash. I think they paid down some debt. But the same thing here, if you look back on 2014, if you had bought them in 2014, you were earning $1.22. And now in 2024, it's going to bring in pretty close to $2. So 50 cents, 49 cents every quarter, which is just shy of $2. I think that's 196, so significantly more. Now, this is where I like it when people talk about it's more important to not time the market. What's more important is time in the market. And I yet like to use the example of Warren Buffett. So Warren Buffett back in '88 bought Coca-Cola, and now on a yearly basis, he gets in dividends almost as much as what he paid for the shares back in '88. I believe it was '88. But, that's unbelievable. Now I've also, the shares that I have that I've owned since '88, my cost basis is so low that, I typically do not want to sell these. So I wanted to share that. To me, it's real interesting. Williams-Sonoma is another one. Now, I talk about like the trade I recently did that I'm calling the shielded wheel. I do believe that people will get out of a stock too quickly, and I believe selling options kind of leads us in this direction too. That, I'm going to take a loss fairly quickly and get out of the stock because it's, it doesn't do well. What I've found in the market over many, many years is almost every company will have a quarter, something go bad for a quarter. For Coca-Cola, it was, when they came out, they changed the formula for the classic Coke, and they went to, I forget I think it was called Coke One or something along those lines. And, they dove during those, I believe it's 6 months or a year. So many people were upset, they brought back classic Coke. And I've seen that happen. So in instances, I found that I've missed some great opportunities. Williams-Sonoma is another one. So I traded them a lot back, I think in 22 and 23, and you can just see the crazy growth they've had. And I had a chance to own them in I believe it was right around this period, right around 100. I think they might have, they got below 100. They were quite a bit lower. So in an instance, they also had issues at times where they had bad reports and they got hit hard. But what I like about them, and you can see, look, if we go to 1 year, they're up $177. This isn't NVIDIA. This is Williams-Sonoma. This is, the store you go in to buy knives and I like the stores. Now, I do think they may be having cooking lessons or something. I don't quite know how they've had such amazing growth. But that's in 1 year. They've grown 153%. So the appreciation, when I look at it now, and I could have owned it around 110, I could have done really well with the appreciation side. And then at the same time, I missed out on some really good dividends. Now, you want to see a really good company that's growing dividends rapidly is Williams-Sonoma. They're ramping them up. They went from 11 to 23 to 20. I think that's around 26 to 14. So that this gives kind of a crazy example when you look at the dividends. So they went from back in 2014 paying $1.39, and then in 2023 they paid $3.48, and they're going to pay. Let's look. They're going to pay almost $4 or $4.25 probably, or $4.50 this year. So pretty substantial. Now they're kind of pricey. I'm not saying go buy some of them. I'm just saying I missed an opportunity. And sometimes when bad news comes out with a company, you need to take your time, do your research, and not bail too quickly. And they were down quite a bit last week, and now it looks like they are popping in after hours, almost $5. So, and what makes them unique is they pay that kind of a dividend, and they're growing that kind of a dividend, and they have no debt. So you come down here to debt. They had debt, but now they've completely paid it off. So pretty amazing. And that's why I like to talk about I'm not just an options seller. To me, options are extra icing on the cake. And I want to own a lot of these companies. I want to pick up this kind of appreciation. And these dividends, my dividends are pretty substantial this day and age. And in another 6 to 7 years, it would, the dividends will probably double with the kind of growth that we're getting. I believe, what was the growth they had over here? It was, you're talking almost 25%. So if we look, they'll tell you, so for the 5 years or the 3 years, 20%. So that's almost like doubling the dividend in 3 years. Because if you do the rule of 72 and you divide by 20 or 21, you're at like 3.2 years, you're going to double the dividend using the rule of 72. Now if they, if they come back down and nothing majorly has changed, it's hard to buy them way up here. If they came back down to this range or even lower, maybe around the low 200s, again, I think we're at 1 day. Let's go to 1 year. But if they came back to this range, like the low 200s, or maybe even the 190s, I might consider doing a trade in them again, because again, their earnings have grown really well. So their earnings, their PE is not crazy. I mean, it's 18, and they're growing substantially. You can see they've had good profits all year. So I wanted to share that, and how with trading, to me, it's also investing. It's owning companies like this. And like I said before, I wish I had allowed some of the contracts to get assigned. Sometimes in my mind, you get into this mindset when you sell options that you roll out of trouble, but sometimes you might be rolling into trouble because you're missing the opportunity to own a great company like Williams-Sonoma. So that's what I wanted to share. Let me know what your thoughts are. How do you sell covered calls? Have they worked well for you? I typically try to respond to my comments within 48 hours. So I'd be curious to see what you guys have to say. And as always, thanks for joining me. I look forward to seeing you next time.